There we go.
Hello and welcome everyone to our webinar today. We should hopefully be having some people starting to join us, which is all very exciting. So whilst we all sort of start to log on this rather unusual day of weather that Victoria and I were just talking about, one day it's raining, then it's not raining, and then it's very damp outside. Would obviously love to sort of say a quick hello, so please do let us know where you are tuning in from, and then we will go into sort of more formal introductions. Oh, hello, we've got Chloe who is tuning in from London, so hello Chloe, welcome. Quite a few people from London. Got a couple more saying that they're in London as well, so they must all be experiencing the same weather situation as us. Oh, okay, we've got someone in Norfolk.
Cologne.
Yeah,
Crikey.
Cologne as well. I know. Hopefully, I don't know what the weather's like in Cologne at the moment. I actually saw. This is classic British people, always talking about the weather, right? And if we're not talking about weather, then we're complaining about the weather. But brilliant. Well, so great to see sort of so many of you joining us today. So as a brief introduction, this is actually the first webinar that Victoria and I have held together. So very warm welcome. Victoria and I actually met, I always want to say a couple of months ago, but it's probably about half a year or so ago now with how quickly time is going. So yeah, we actually met quite a while ago at a lovely networking event and have been in touch ever since. And so Victoria's very kindly said that she's going to co-host a webinar with myself, and quite an interesting topic as well. So not one of our normal webinars, I should say. So today's webinar, we will be sort of discussing personal finance tips, which is, I guess, very important, and actually very interesting what we were just talking about with sort of mortgages and interest rates in the cost of living crisis that we're in at the moment. And obviously interest rates have gone up again. So Victoria is very much here on hand to sort of hopefully give us, and I know she will, give us a deeper knowledge of sort of the investment industry, its participants, and understand different types of investments as well, and sort of then hopefully help you with sort of from your own sort of personal perspective, how best to place you. So bit of an introduction about me for those who don't know. So I'm Elspeth, and I am at CNC Search. So we are a sort of specialist agency, and I predominantly focus on people, HR and talent from a recruitment perspective. Very passionate in regards to that learning and development aspect for me. And then we are joined by Victoria, who is an investment manager. Shall I do sort of a brief introduction to who you are, Victoria, and you can sort of tell people a little bit more about who you are. But you co-founded, well, I think you've been in investment for 18 years or so in industry.
Yeah, a long time.
Time flies very quickly. I always think it's 5 years. I know the team at work, they always say, you've been saying for about 5 years that you've been in recruitment for 9. I'm like, no, let's just stick with the 9 years. So 18 years you've been in the industry for, and you co-founded Manorbridge 5 years ago. Yeah. Wasn't it? Again, gosh, time goes very quickly.
Really.
So yeah, do you want to sort of give people a little bit more of an introduction about who you are, and then we will kick off with the presentation?
Yeah, absolutely. As you mentioned, I'm an investment manager, so my day-to-day job is looking after people's wealth and helping them develop it, which I love. But also, like you, on the education side, I think there's such a knowledge gap when it comes to finance, the financial industry, personal money, and yeah, anything I can sort of do to help that. I'm really happy to be here.
Brilliant, great. Well, we will do a Q&A session at the end. So if you do have any questions, please do pop it in the box. You can either sort of take it out of board, but there is a little Q&A and there is the chat. Hopefully you can all see on the webinar. So yes, any questions, do pop them in, and then Victoria will be answering those at the end. So over to you, Victoria.
Wonderful. I will share my screen. Bear with me. There we go. Hopefully that's come up okay. Great. So we'll start at the very beginning. It's going to be a bit of a whistle-stop tour of finance and investing. So to start with, what is investing? If you look at this slide, I've literally looked up the dictionary definition of investing. I'm not going to read it, but put simply, investing is using your money to generate an increase in value. you buy something for £10 and you get back £20. But also more broadly, investing is defined as devoting time to achieve something. So we're actually all investors, whether we like it or not. Every time you decide to use your wages to buy an outfit for the weekend or put it into your savings, you're deciding whether to invest in your appearance today or in the ability to buy something potentially bigger in the future. And cheesy, but hopefully you will decide later on that this talk was a good investment of your time. Industry participants. So who are the investors? Who are the people making these decisions? Investment is actually all around us. All of us are exposed to the investment industry and the success or failure of different investors. If you have mobile phone insurance, insurance companies can't make payouts unless they invest the premiums you pay successfully. Have a pension? Same thing. Been to university? Many universities have portfolios of investments and they use the proceeds to supplement tuition fees to provide a better experience to their students. And you might have savings and have thought about what to do with them. All of these types of investors on the screen deploy money they have into different types of investments. So we're going to cover some of those just to give a bit more background. My industry likes to use a lot of jargon, but the bottom line is most investments are either in equity, which can also be referred to as stocks or shares, or in debt, which can be called credit or bonds. One further difference worth understanding is that both equity and debt can be public or private. Public means that the equity or debt is listed on an exchange, like the London Stock Exchange, and the result is that anyone can go and buy a share in the company. Private means that you have to reach an agreement with the owner of the company on a one-to-one basis to buy a holding or buy the whole company. If you think of it, if anyone's seen Dragon's Den, the companies that are on there are private. So that's why the contestants have to reach an individual agreement with one of the dragons to take their money. I won't cover hedge funds today, but I'm happy to take questions if people are interested. What is a fund? Funds are ready-made baskets of investments. When you invest in a fund, you're buying a mix of assets, which can include shares, property, government bonds, cash, corporate bonds, and funds actually save you from picking the individual investments themselves. There are two main types of fund. Active funds or multi-asset fund are run by professional fund managers and they choose the underlying investments within the fund, the shares or the bonds or the other assets on your behalf. You tend to pay extra for the fund manager's expertise with the aim that hopefully the returns you receive will outperform the market. A passive fund or an index fund, or sometimes referred to as an ETF, exchange traded fund, they simply follow or track a market or an index. So there's no active involvement there from a fund manager. And the result of that is they're often cheaper and less fees. Funds can vary in risk from cautious funds at the lower end of the scale to adventurous at the high risk end rather. What is a share? Shares are ownerships of units in ownership of a company. When you buy shares, you're effectively buying a small stake in the company. So it can be quite cool to think that, you partly own Microsoft or Amazon. Companies sell shares to raise money, which they then can use to invest in their business and expand their businesses. Investors are also known as shareholders, and they're free to buy and sell shares on the stock market at any time. If a company is performing well that you've bought or is expected to perform well, demand generally increases and that pushes up the share price. On the other hand, if the company does or is expected to do badly, the opposite will happen and the share price will drop. There are lots of other factors that influence share prices, such as interest rates and the wider economy as well. And it's worth noting that as a shareholder, the value of your investment rises and falls with the share price. So whilst the money you invest has got the potential to grow, it can also fall in value and you might get back less than you originally invested. Diversification is a really important risk management tool when it comes to investing. This means spreading your money into a range of investments rather than just focusing on one winner. It's kind of the not having too many eggs in one basket theory, and tries to avoid, disaster events, one of which, I don't know if you will remember, the BP oil spill a few years ago. The share price of BP lost 55%. So if that was your money, you've seen it halve overnight, which was pretty terrible. So in addition, and there are these unforeseen events all the time, with the best will in the world, one can't predict the future. And when some investments are performing badly, different areas or sectors might be performing well. So you can see the colours are not great, but the top line on this chart is Shell, the oil company, which has performed really well since 2021. And on the bottom line is Ocado, the online shopping retailer. And since the pandemic, their share price has fallen because we're all able to go into supermarkets. So volumes are less, but you can see there, if you have some money in each of those, your the downside is limited. So how does this affect me? There you are with your nice tie on. This slide is trying to help you think about how you can consider your assets, your personal situation, and how you can take that forward. So the first thing to consider is your current financial position. If you've got unsecured interest-bearing debts such as credit cards and loans, you really should pay these off and build up some savings behind you before you start investing. It's useful, I find, to list out all of your incoming and outgoings along with your assets so that you've got a starting point to work with. Then if you're a super geek like me, you can even track this over time and you can see how your wealth is developing over the years. Your goals, if you're trying to build up enough money to cover the cost of a car or a holiday or a wedding in the short term, then investing probably isn't the right option for you. But if you're putting money away for something for at least 5 years away, such as a child's education, or maybe just more flexibility later in life, then investing could be your answer. The sooner you start, the longer you can leave your money invested, the more time it has to grow and recover from any bad periods along the way. This links into my next little bubble of time horizon, which is important when you are thinking about your assets. If you're looking to invest your money, you really should forget about it for 3 to 5 years. If you might need the money in this time frame, then it's not really worth investing it, as the stock market doesn't always go your way. In addition, if you're younger, you might have more time on your side to ride out any turbulence. So you might want to consider a more adventurous approach with your money. But on the other hand, as you get closer to retirement, your investments could have less time to recover from any market dips. So a more conservative strategy could be appropriate for you. And then when it comes to feeling about risk, no investment is risk-free. You are putting your money into something you believe will go up in value, but obviously there are no guarantees of that. You'll be exposed to the uncertainties of markets, which again means that your investment can and will jump around and you could get less than you put in. With investing, risk and reward go hand in hand. As a general rule of thumb, higher risk investments, including shares, have the potential to give you higher rewards, and the vice versa, lower risk investments tend to equal lower rewards. But you can start by investing very little. Starting small is a really great way to kind of dip your toe in the water, feel a bit more comfortable, and then you can watch what happens to your investments and perhaps add more at a later point once you're feeling confident. There you are again. It can all seem really complicated. So what I'm trying to get across here is showing how you can compartmentalize your savings and assets so that they make a bit more sense. On the left, you've got cash or cash-like assets, which can be anything from short to medium term money. That budgeting tool of the 50, 30, 20 is super helpful. And what that means is that you budget for 50% of your after-tax income for needs, so your rent, your mortgage, food, and then 30% is for wants, clothes, holidays, whatever it is you're interested in. And then the remaining 20% can either be to pay off that debt or to put into savings. Ideally, you'd have an emergency savings fund worth about 3 to 6 months of your living costs first. That way, you've got money available to cover unexpected costs without needing to dip into your investments. And then the final point there is worth making sure your bank account is paying you interest, and we will talk about this on the next slide. And the box on the right are long-term savings, and this is where things can get a bit more exciting, as you've got time horizon, as we discussed, available. So in there, I've popped ISAs, pensions, and trading accounts, which again, we'll come to. Here are a few of the different types of benefits you can achieve from your bank account. The days of zero interest are over for the time being, so it really is worth ensuring your cash works for you. You can see on there there's cash rewards for switches, savings interest up to 5%. You can compare different offers with good old Martin Lewis at moneysavingexpert.com. Okay, now some of the more technical things. ISA. ISA stands for Individual Savings Account. The main difference between an ISA and any other savings account is that it offers tax-free interest payments, so you can get a bit more for your money. There's 4 different types of ISA that I've listed on there. And the amount you can add to your ISA is set by the annual allowance, which for this year is £20,000. You can split your allowance across different types of ISAs. So for example, you could put some in a cash ISA and the balance in a stocks and shares ISA, but you can only open one type of each ISA within the year. So only one cash ISA and only one stocks and shares ISA. These days, ISAs are actually a lot more flexible than they used to be, and you can withdraw money from an ISA and replace it within the same tax year without it affecting your annual allowance. I'll just cover some of the types of ISAs there. Cash are tax-free savings accounts. You pay no tax on the interest that you earn, and you can actually open some with as little as £1. Different types of those are instant access, limited access, fixed rate, meaning that your money's kept for a fixed term with an interest rate that doesn't change. You can think of a stocks and shares ISA like a wrapper that sits around a portfolio of investments. That wrapper means that you have no tax to pay on any dividends, growth, interest, or income that you receive from those investments. The next one, innovative finance ISAs, they help you earn tax-free interest on things like peer-to-peer lending. And then the final ISA there, lifetime ISAs, are a relatively new development over the last few years. And if you're aged between 18 and 39, you can save up to £4,000 a year every year until your 50th birthday. Then on top of that, the government will give you an annual bonus of 25%. So if you put the full 4,000, you get an extra £1,000 on the contributions you make. Funds put in a lifetime ISA can be withdrawn at any point to pay for a first home. So it has to be your first property with a value less than £450,000. Or you have to wait until you're 60 to be able to withdraw for any other purpose. But I sort of see it as another little savings pot next to my pension. If you wanted to make withdrawals before you're 60 and not for a property, you can do that, but often a 25% charge applies to the money that you're withdrawing. Pensions. Pensions are a really tax efficient way to put money aside for later in life to provide an income for when you retire. And depending on the type of pension you have, you, your employer, and other people like your spouse or children can actually pay into it. And then the government also contributes to your pension in the form of tax relief. Then once you're 55 or you retire, you have a number of options for how you choose to take your pension income. You can pay into as many pensions as you like, depending on how much you can and want to put aside for when you're older. However, there are limits to how much you can contribute to your pension each year and over your lifetime. And it's important to know that pensions are almost always invested in stocks and shares. So again, the value can move around and you can get less back than you put in. How a pension works in practice will depend on what kind of pension you have, but in really simple terms, there are three things to know. You and others can contribute to it. The government tops it up through tax relief, and you have a pot of money to live on later in life. It's generally a good idea to pay into a pension if you can. Once you retire or hit 55, you will be working less, or if at all, and you'll need to receive an income to live on. The sooner you start thinking about where that income's going to come from, the more prepared you're likely to be, and the better chance you'll have of living the lifestyle you dreamed of. Whilst there are obviously other ways to invest, a pension does provide some great benefits when it comes to putting money aside for your retirement, being you get tax relief on the payments you make, which we've mentioned from the government. They add 20% onto any contributions you put in up to a certain limit. And if you're a higher rate or additional rate taxpayer, you can claim more via your tax return. If you have a work-based pension, your employer is legally obliged to contribute to it on your behalf. So not only do you receive the government contributions, your employer can be topping it up as well. But there is more. Pensions investments are actually free from income tax and capital gains tax. So you don't pay any tax on the dividends from the shares contained, and you won't pay any capital gains tax on any profits within the pension pot. There will be income tax implications when you start to withdraw the pension in the future, but I won't cover that just today. One thing I often hear from clients or friends or, acquaintances is that investing seems scary and it's too scary to look at and get started. So I wanted to show this slide because hopefully it displays the benefit of being invested for the long term. This is a chart of a balanced portfolio, which is diversified, like the ones we've already discussed in this presentation. As you can see from the graph, there have been various downturns over the years. The tech crash in the early 2000s, the 2008 Great Financial Crisis, COVID, inflation worries, but on the whole, the trajectory is up. It certainly isn't a straight line, and it's important to stay invested and sometimes ignore the noise. It's a miracle. Who knew? Here I wanted to discuss the miracle of compound interest. This is probably where I lose some of the room to maths, but I promise to try and make it interesting. So on this table, simple interest, the first column, is a fixed amount every year. So 10% based on the original investment of £1,000 gives you £100 each year, making a total interest gain of £300. Compound interest on the far right column is calculated not only on the base amount, that £1,000 you invested, but the interest on the interest that you've already earned. So you can see the difference there is an extra £31. Einstein actually said that compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. Here we're just extending out that time frame, you know, to show you again the benefit of being invested for the long term. On the sort of second column, you can see after 20 years, the money invested with simple interest is £24,000, with total interest gained of £14,000. And on the far right column, you've almost, well, more than doubled your the interest that you've gained. And actually, if you do, you know, monthly contributions, that kind of thing, that can really help the situation. There is a compound interest calculator if anyone fancies some fun on the internet, so you can play around with these numbers and see how much you can make. That's just the equation if anyone was interested, to calculate compound interest. Inflation is everywhere in the news in the moment, so I thought I'd touch on it within this presentation. So in economics, inflation is the general increase in the prices of goods and services in an economy. When the general price level rises, each unit of currency buys fewer goods and services, which hopefully you can get by my sourdough analogy. Consequently, inflation corresponds to a reduction in what we call the purchasing power of money. So this is an argument really to ensure your savings are working for you, especially the long-term ones, as you know, with inflation at 7, 8, 9% as recently released, you very quickly lose your spending power. On this slide, you can see the different options to get started investing. On the far left is the cheapest option with the lowest level of service. So that is to choose the investments yourself. And whilst that technically will be the cheapest option, obviously it takes a lot of time and research to decide what it is you want to buy and sell. The next option over to the right is robo-advice. And these are either online or apps which provide automated investment advice with no human intervention, excuse me. And an example of this would be something like Nutmeg, which is a platform that invests in tracker funds. So once you've selected a risk level or an investment style, you are set up with your funds. A model portfolio is a service offered by a number of wealth management firms whereby your risk level and objectives are matched with a pre-created portfolio of assets by an investment professional, which can change over time. And then on the far right, you'll see me. I'm a dedicated investment manager, and my role is to look after your money and invest in a bespoke portfolio for your needs. Our view is, you know, no two individuals are the same, so no two of our portfolios look the same either. And whilst this is going to be probably the more expensive option, you have a dedicated person on hand whenever you need, and you gain the highest level of service. As a summary, here are the takeaways that we've covered, investing tips for beginners. Investing is for the long term, ideally 3 to 5 years or more. The higher the potential rewards, the higher the risk of losses. You actually don't need to pick your own stocks. Many first-timers start investing in funds. Diversification can lessen the impact of any one investment performing badly, and start as early as you can so that your money has more time to grow.
Brilliant. Well, thank you so much, Victoria. Really interesting. I know for me, have definitely learned a lot, and actually we've had some really interesting questions that have come throughout your presentation. Great. So with the first question, it is going back to sort of that pension aspect. So naturally, when you join a new organization, automatically get enrolled into that pension pot after sort of 3 months being within an organization. Now, naturally, if you do move jobs, obviously different organizations use different pension providers. So what would your advice be? Because there's always a bit of conflicting views, you know, should we be transferring all of our pension into one pot, or is it safer to have it in lots of different pots?
Good question. So it's worth caveating that everyone's circumstances are different, and it very much depends on the type of pension you have. Some schemes are super attractive and should be left well alone. However, if it is a sort of off the shelf, you know, the likes of Standard Chartered and Scottish Widows and those things, often combining your pension can be much more cost effective as one point, because you're only paying charges to one company, and you often have a larger pot to invest. So sometimes fee scaling can help with that. And just purely admin, you know, the number of times we've had clients come on and speak to us and say, oh, you know, I've just found this pension from 20 years ago and, you know, got paperwork through the post. So sometimes, you know, admin wise, cost effective, it does make sense to combine them where you can, depending on the type of pension.
I mean, impressive if someone's still got paperwork from about 20 years ago.
I know, you'd be surprised.
And then, and again, another really interesting sort of question from someone. It's looking at 0%. So if you have debts of 0% on credit cards for 2 years, would you recommend pushing your money to pay it off, or put it into a savings account and pay off the minimum for each month?
So sorry, say again. So you've got a credit card that's 0% for 2 years.
Yeah. Would you recommend paying it all off on the monthly basis, or paying the minimum off per month and then using that additional money to sort of put into a savings pot or a savings account?
Sure. So I think in that it's a bit of a balance. So yes, 0% is really attractive, and you know, lots of us use it for sofa purchases and things, you know, high value purchases. But after 2 years, obviously that 0% disappears. So if you haven't paid it off, you start, you know, I'm sure the interest rate will be significantly higher. You can move these accounts around and try and take advantage, but I guess it's down to the level of the debt. You know, if in the future, if you were to pay an interest on that debt, is it manageable? You know, I think it does make sense to pay down these debts as much as possible, but yeah, balance really is the answer.
Definitely. And sort of going back, we've had another question in regards to your slide a couple of slides ago, in regards to how you can do your own self-trading, and then obviously up to you, up at the end. With the likes of social media, we're noticing that there's a lot of, I guess you could call them push posts. Someone who's not very up with the old social media on my side, is that there are obviously influencers who are encouraging, you know, doing trading. So what would you recommend in regards to making sure that if that is what you're looking at, that you go around it the right way?
I think do your research. It's a really difficult area, the sort of investment influencers, and for a number of reasons. The first being, you know, those investments might not be particularly right for you. You know, doing your research, for example, cryptocurrency, you know, you have lots of influencers telling you how much they've earned and things, but that's actually a super high risk investment. And if your attitude to risk and if losing money would keep you up at night, you know, it's really not appropriate for you. The other one being influences, sometimes it can be a little bit of an echo chamber, right? You know, people often are quite happy to tell you when they've made money, how much money they've made, but I haven't seen many of them tell you when to sell, or tell you, you know, actually I made a mistake here, or you know, not everything you buy will go up, and everybody makes mistakes. And you know, as we talked before, there are always unforeseen events that happen in the wider global economy that you just can't plan for. So it is really important that, you know, only invest money you can risk, and getting that spread of investments is really, really important. And if in doubt, don't choose the investments yourself, you know, use one of the alternative options, because it's a really tough area. And you know, for example, being a regulated individual, I can't give individual investment recommendations to strangers. You know, it's not allowed, because those investment recommendations need to be suitable for the person that's receiving them. So these people that are doing the influencing aren't in my industry, because they would be regulated people. So again, you know, where are they getting their research from? Where, you know, it's really important to do your own looking.
Yeah, amazing. Another question. So the question is, so how do we choose a compound interest account? Are the regular ISA/saver accounts doing compound interest?
Yes, yeah, they will be. It was more sort of trying to explain the theory behind it, really. But yes, yeah, when you, I don't know if anyone's got, I've got a little Chase bank account, and you know, you get monthly interest, but it's based on the money that's there for that month. So yeah, they will be compound interest.
And we've had quite a few questions that have come through, which is always brilliant. With regard to, I guess, basics, right? So savings account with your bank account, who is it best to speak to in regards to then setting up a savings pot with your bank account? And actually, I know you mentioned, you know, going online to compare different interest rates, but what would you advise the best step to be when sort of looking to set up a savings account?
Yeah, I really do. Martin Lewis is wonderful, you know, and he's always updating his website with the latest investment interest rates and things. So he's really brilliant source to go to. So, you know, the things that are important are, what's the account for? You know, can you tie up the money for any particular amount of time? Because there are set period savings accounts, there are easy access savings accounts. You know, it's sort of down to you what you want it for. But yes, he's got such an amazing source of information, and it will compare all of the different interest rates, but also all of the accounts on there are at regulated banks and covered by the Financial Services Compensation Scheme, which is also important.
Right. And would you recommend also for those just having that initial conversation with their current bank anyway, but to see what the different options are? Because again, there's so many different, you know, you get 10-year loyalty saver, 5-year loyalty saver, your flexi account, there's so many different options as well. So would you, you know, suggest that it is worthwhile just arranging a quick appointment with your bank or sort of a telephone call with them?
Yeah, absolutely. I mean, knowledge is power, isn't it? I think that, you know, having a conversation with them and seeing what they offer really makes sense. And obviously setting up with the same bank account will be easier because they already have your details. But that said, it really isn't difficult to set up bank accounts these days online, or apps, or even move your money around. I think I mean, it is an admin, isn't it? And it's everybody's bugbear. But
yeah,
if changing bank account is really quite easy these days, and the banks do it all for you. They transfer all of your direct debits, all of your standing orders and things. You really, you know, don't have to think about it.
That's quite interesting, actually, because I think it is almost that mindset, oh, it's going to be such an admin heavy task
Yeah.
to change bank accounts. So it's actually quite interesting to hear that that's all taken care of for you, actually. And I guess for me personally, what I found really interesting was your sort of 50-30-20 concept. So would you mind just sort of re-explaining that a little bit more in depth? And actually, I think what would be beneficial is with the follow-up, we could include that breakdown that we sort of send out to people as well.
Yeah, very happy to. Yeah, it's a really clever sort of budgeting tool to try and make life easier. Make life easier, but also thinking about it more consciously. So once you have your payslip, or you see your income go into your bank account, so it's after tax income, literally do the maths, divide it by 2, essentially, so 50%. So half of that you allocate for your needs, so your mortgage, rent, food is a need, those sorts of things, toiletries. And then 30% is for your wants. You could, for holidays, or anything like that. There's not a necessity, but a nice to have. And then the remaining 20% you can either pay down some debts, or invest it, or save it. So it's just being a bit more conscious about the money that you have. And sometimes even moving it, if you have got multiple, I know Monzo are quite good at letting you have multiple accounts, so you could, okay, that goes in that pot, that, and you could actually physically move it, not just mentally, so that it makes life a bit easier. And you might find that over time, you're spending less on your wants, so that could shift over to your savings as well. And yeah, it's a really great trick.
Yeah, great. Well, I think that's all the questions, unless there are any last minute questions that come through. But what will we do is that I'll be sending out a follow-up email for all of those who joined us today. So thank you very much. It sounds as if we've had people from everywhere, which is great, such as Milton Keynes, all the way through to Bulgaria. So I will follow up with an email. I will obviously put in Victoria's contact details in there as well, if you wish to reach out to her directly. And then we'll sort of pop in some key follow-ups as well. And I think definitely including that aspect that you've mentioned as well. But thank you very much for joining us, Victoria. And I hope everyone has a lovely rest of their day.
It's a
Brilliant.
pleasure. No, enjoyed it. Thanks,
Thank you.
Cheers.